What if you could access funds for your startup without having to take out a full loan every time? This flexibility is exactly what a business line of credit offers, but how does it work? And why is it so crucial for startups navigating the challenges of early-stage growth? To understand the value of a business line of credit, let's first explore what it is. A business line of credit is essentially a flexible financing option that allows companies to borrow up to a predetermined limit. Unlike traditional loans that provide a lump sum upfront, this type of financing acts more like a revolving door. You can draw funds as needed and repay them over time, with interest charged only on the amount borrowed. For startups in particular, this flexibility can be life-saving. Early-stage companies often face unpredictable cash flows and sudden expenses. Whether it's funding marketing campaigns or managing inventory fluctuations, having quick access to capital without committing to large sums up front can make all the difference. How does it work? The process begins with an application to a lender who assesses your personal credit score, typically requiring at least 650 to 680, and your startup's financial health. For pre-revenue startups, or those with limited history, factors like investor backing or signed contracts might also be considered. Once approved, you're granted access to funds up to your predetermined limit, usually ranging from $10,000 to $100,000 initially for startups. You can draw on these funds as needed during what's called the draw period, which typically lasts between 12 and 24 months. Interest rates vary based on risk, but generally range from 8% to 24% APR for startups 1. Some lenders offer introductory fixed rates for initial stability before moving into variable rates based on market conditions. Repayment terms are designed with irregular startup cash flows in mind. Initially, you might only pay interest-only payments for several months before transitioning into minimum monthly payments based on your outstanding balance, often around 2 to 3%. Types of business lines of credit. Business lines of credit come in several forms tailored for different needs. Secured business line of credit. This type requires collateral such as real estate or inventory. While it puts assets at risk if defaulted upon, secured lines often offer lower interest rates, typically between 8 to 13%, because they're less risky for lenders. They're ideal for tech startups with valuable hardware or biotech firms holding significant intellectual property. Unsecured business line of credit. Unsecured lines rely solely on your creditworthiness without requiring collateral. However, they usually have higher interest rates, often between 12 to 20%, due to increased risk, and may have lower limits $5,000 to $50,000. They suit software startups or service-based businesses where physical assets are minimal. Revolving business line of credit. Revolving lines allow continuous borrowing as long as repayments are made timely. Limits typically range from $10,000 to $75,000 initially, but can increase with business growth 1. These are perfect for e-commerce businesses dealing with seasonal demand fluctuations. Advantages. So, why do so many entrepreneurs turn towards business lines of credit? Here are some key advantages. Flexibility. Access funds when needed without committing large sums up front. Cost efficiency. Pay interest only on borrowed amounts. Cash flow management. Ideal for handling unexpected expenses or seasonal fluctuations. However, there are also some drawbacks. Higher fees compared to traditional loans. Short repayment terms in some cases. Despite these potential downsides, though, overall flexibility makes them invaluable tools, especially during early stages when predictability isn't always possible. Understanding how business lines work empowers founders navigate financial challenges effectively while building strong relationships, lenders essential future expansions. With that said, thanks for watching until next time.